with our guest, John Herrmann, owner of Herrmann Forecasting, and Ron Blackwell, the chief economist over at the AFL-CIO. And John, I'm going to start with you. So worker productivity surged at the fastest pace in 6 years.
Yes.
Labor costs fell. So does that signal that companies may be getting ready to hire after kind of letting go so many workers, cutting costs to the bone?
I believe so. Number one, those indicators are all good. We were looking for that kind of thing, very strong productivity, very low unit labor costs. So we're looking for that. That's not the best model to be forecasting some of these things. The ones that we have, it's almost pinpoint. It's saying within 3 months. So it's saying that the employment report that actually should show a gain is the one report on January the 8th. It's pinpointing this thing. It's like a dart that's getting thrown at a dartboard. Hey. So that's what it's telling us. You
know what, let me break in. I want to get Ron's take on this, because the productivity number has been, economists all day, Ron, have been saying this is a great number. It's so bullish. We're going to see hiring bounce back because of it. But a lot of workers and people who represent workers maybe are a little concerned about it, because it seems to point out that people are firing more of their workers. They're paying those who remain less and making them work much harder.
Look, productivity is good, and we're glad to see it improve, but I think the main reason it's improving is a deterioration in working hours, which in the third quarter are at record lows, 33 hours a week on average. And the fall in hours makes the productivity numbers look good on a given amount of output. So I don't think that augurs well for investment going forward.
So, Ron, you don't think companies are getting ready to hire workers, bottom line?
No, I think what you see is the job loss, net job loss, has decelerated radically from the early part of the year, and it may be lower now than it has been even recently. 175 would be the lowest number we've seen. But I think that's likely to continue.
I mean, we do have several.
It's decelerated because the laying off of workers has slowed down. Well, but there's no sign of new job creation.
Okay, so you know, he's right in terms of saying, is there a sign today of job creation in the aggregate? The answer is to that, no, when you add it up in the aggregate. But there's several sectors where we are seeing workers being recalled. We're seeing it in manufacturing, we're seeing it in finance, we're seeing it in information, we're seeing it in leisure and hospitality, we're seeing it in other services. There are many industries where we're seeing recalling workers, but on net, and even tomorrow, we should see a gain in temporary help workers. This will be another.
And that's a good sign.
That's a leading indicator of job growth coming in the pipeline. The other indicator in terms of the unemployment rate, I'm one of the people looking for a bigger jump in the unemployment rate than the consensus. But there is a leading indicator for that, and it's the weekly insured unemployment rate that we just see every week, and that is already peaked and turned down, which means that we're most likely going to get a gap up tomorrow in the unemployment rate. We'll go into that in a few seconds. But the thing is, once we get past that, it should start to peak out and start to gradually grind and roll over, just gradually.